Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the Econ Show, we have a decent amount of new data that's come out, some on the global side, but a lot of it is a bit US and Europe centric, especially when you look at US GDP that came out today, and then we have a lot of leading indicators coming out from the Fed regional banks. So we'll go through some of these different pieces and what do they mean, and then wrap it up with what's happening with European inflation, growth, and then some additional headwinds that have propped up in China when we look at some recent issues on bonds and developers, because again, nothing new, but just maintaining some continuity on that side. And then when we start looking at Japan, South Korea, some things are starting to turn around, India as well. So China is going to be a bit more of the focal point, but then we're going to look at some of the positives that we've seen, especially when we start looking at some of these other Asian nations at this point in time. So now that we've gone through just a quick summary, we just want to touch on what is happening with this global investment. And it's interesting because global investment has really outpaced that bounce from the global financial crisis. And there's a lot of reasons why that's the case. And one of the biggest things that we've been highlighting is that you were going to get this real investment process because you had obviously a ton of money get dumped into the market, but you also had a severe supply chain where everybody who was essentially focused on this one area where we didn't need to diversify, we didn't have to worry about what the supply chain was doing. Well, they've been proven wrong. And now it's a matter of, making sure that you have redundancies, making sure that maybe you're not relying on one side too much. So you're starting to see some of this investment pick up fairly quickly. And you've had fairly low investment over the last few years. So there's also a certain amount that has a catch up. So again, a lot of this has been pulled forward, which is a net positive. So when we talk about some of the headwinds that we see on the financial side, especially when we look at economic growth, a lot of that is inflation, consumer driven, where when we look at on the investment side, on the corporate side, there is positive, and that's where we get some of this back and forth, and we saw it play out in the GDP number, where you had the consumer slowing but still remaining strong as they pivoted from goods into services, but also that rebuild on some inventory, that investment on some of that corporate side, that is going to help soften some of that blow, which is why when we talk about some of these headwinds, we're not sitting here saying we're going into a steep recession. It's just that growth estimates are wrong. They have to come down but there is a certain amount of stability just based on where inventories are and where corporate investing is going to be. Now, a lot of this has been pulled forward due to low rates, due to the need to solidify and strengthen your supply chain. But this is going to again get us closer to that growth cycle, which will provide some of those benefits. The other issue is, as we've talked about, between developed and emerging, this is a lot of developed focus and not as much emerging focus. Now, there's some winners and losers in that emerging market comment, because there are places in Southeast Asia that are really going to win. But China is going to lose on that because you're taking some things from China and moving it into other regions. So again, there's going to be kind of this mix and shift in terms of where it is. And it's not instant. It's something that takes time to play through the market. Now, when you start looking at global value chain shares of world trade, this is also where you're starting to see some of these headwinds that we've talked about, where supply chain crisis, fueling desire to retreat from globalization. But again, this is something that the financial crisis also did. The share of world trade accounted for by global value chains where product crossed at least two borders rose from 37% in 1970 to 52% in 2008, when it then plateaued. So we're past a certain amount of that growth, but now you're going to see it come down a little bit more, because again, as we just said in the first slide, there's a need to diversify. There's a need to, how much of this do we have? Can we send abroad? How much of it can we bring back? And again, we've shuttered facilities. Like when we just did a due diligence check on and site visits for our potential hydro dams. And, across the way, there's a mill that closed down a few years ago, and they took the wires down. They cut the wires. They sold everything within as a fire sale from within the facility. The roads have cracked because nobody's been taking care of them. The access routes, the rail lines coming in. So if we wanted to reinvest reinvigorate that specific location, that's not just a snap your fingers and it's there. How many people moved away because this is a small town in New England? What does it take to rerun the lines, to power it up, to buy all the equipment, to make agreements and to source raw materials as well as offtake? This is not something that you just snap your fingers and it happens. It takes time, which is why, and we've said it before, I'm not so much in agreement with the need for the stimulus in March, but we do need an infrastructure bill. It just has to be focused on realistic things in terms of roads, rail, industry, and less about building a billion superchargers for EVs. Like, this is something where we really need to hit the ground running and really kind of juice and enable people to come back. And again, not to say that we're going to continue to come all the way down, because we have been exporting inflation. We've been exporting our supply chain, and some of it does have to come home at this point in time. But again, there are still challenges. It's not like we're coming from this blindly, because and the issue is that we've talked about to clients in Q4 2019. For those that have been reading us for that, we thought things were slowing. We were not bullish in Q4 2019. We were not bullish in Q1 2020, just because you had some backdrops. Things were starting to get a little heavy. You saw slowdowns. You saw economic pressure. So to even compare against Q4 2019, Q4 2019 is a low bar, and that's how far we've come down. And this is looking globally. When you look at GDP and employment, you can see just how difficult things are going to be over the coming few years. And it's going to be a little bit tougher because of inflation, because of supply chain, because of wage issues, because of costs in general. And again, those are going to be some of the underlying problems that we're going to continue to see through the system. With the U.S., again, we've seen the boost in GDP, but the employment side is the one where we continue to see those problems. That's why are people not coming back? How do you bring people back? Where do you get some of this cycle? And then is that going to be the next leg of inflation that I think is being missed? Where when you look at Australia, Korea's an interesting one, because there is a lot of growth there. There's a lot of opportunities. Same with Vietnam. India is kind of a mixed bag in terms of where things. Obviously, it's not here because this is looking at OECD. But when you start looking at India, you start to see some potential opportunities. Then there's some growth in general. And this isn't all OECD. It's just some of the bigger ones that we looked at. Where Russia's seeing additional problems in Australia. Australia is going to benefit because they have raw materials. It's raw material centric, but they have growth issues. They've obviously had a steep lockdown. So there's going to be struggle. There's going to be some problems to get this back to normal. It's just we're on a certain path, and how much of this fiscal drag is going to happen. And this is where you have to start letting the market decide and move on its own, versus trying to continuously prop it up. But when you look at the curve flattening, you're starting to get some concern, because when you look at the gap between long and short-term rates are collapsing globally, and it just means you're starting to get a flattener, where people are looking for a bit of safety, so they're buying short-term debt, and they're looking to sell longer-term debt, which again is causing this flattener. And that's where you start to get some pressure, where, well, why is that happening? What is it? Is it because people are buying up the front month and you're going to get a little bit of a bear steepener? Or is this something where people are looking at the long end and going, you know what, I can't be here. I'm concerned about inflation. I'm concerned about growth. And you just leave your front end alone, and you start selling the back end, which again would cause that to drop. So there's a bit of a mix where the 20-year in the U.S. is actually now above the 30-year. So there's a lot of different shifts when you start looking at what is coming, how is it happening in the market, and these are going to be concerns when you start looking at what does growth look like and what does inflation look like, and how is that going to play out over the next few years. So then when you start looking at the global recovery continuing into 2022, and the thing is, supply chain issues are going to abate, and they'll get better. They're not going to go away. There was a great article that we just tweeted out from a truck driver's perspective, talking about how there's a lot of issues at the port side, and there's been issues at the port side, and this isn't new. It's just now come full circle. People are now fully aware of it, and it has to be addressed. But in that same purview, you have to look at where is the year-over-year GDP growth and where are we sitting. So when you look at 21 from the world side, the expectations here at 5.6% growth, 22 at 4.9% growth. When you have to look at what are some of the things that are driving it. So in the U.S., you obviously have a lot of fiscal support. That has been a driving force. You've now, with the new numbers coming out, the 4.6% has dropped down to about 1.6%. But then like the euro area is doing well, but it's not doing as well as forecasted. And that's where you're starting to see some of these roll downs, where Japan's something similar, where it's been kind of a slow move back. And that's where when you start looking at like China, that has to come down. The UK is facing a significant amount of headwinds when you start looking at prices. Prices have gone up, inflation, something very similar. So China and India are the ones that we see the most risk for a downshift as we continue to see some of this play out, especially when you look at the U.S. coming in lower, which again is going to pull down some of that world growth. But these are going to be things that you'll have some positive numbers come out, you'll have some weaker numbers. So again, these are going to be some of the different shifts in general. And then when you look at the ship waiting times outside the port of LA, they continue to get worse. And that's, again, not going away this year. This is, what does it look like as we get into Q1, Q2 of next year? And how are we progressing? Are we starting to work through it? Because you do have that normal lull time that comes in Q1 after that big surge, obviously, for the holiday season. Now, one of the interesting things here was demand for less skilled workers in the U.S. has risen as the economy recovers, but it's also tied to China. When you start looking at, again, that reshoring or some of these lower educated jobs or lower skilled jobs coming back, that's providing a little bit of a boost. But is it just a one-time boost? And the answer is yes, because it's going to take time to move all of this back. So you scrambled, you needed different individuals to fill a void because you couldn't get it from abroad. So you were maxing out utilization rates from whatever was available in the U.S. And now if you want to see a more sustainable adjustment, you're going to need to see some of this reshoring. But then when you look at some of the squeezes, this is when you start looking at food inflation and total inflation across the OECD countries. And this is where we see that pressure on the consumer. This is something that is only ratcheting up, not down, when you look at where things are. Because in September, prices started to normalize a bit, and now they've reaccelerated in October, and we see that continuing well into November and December, which is why when you look at the CFO survey, that's where they are looking at the U.S. economy with a little bit of caution, their own economy with a bit more caution as these risks continue to play out, as we've discussed previously. And that's when you start looking at U.S. CapEx and where that looks for the equipment and IPP, where you're starting to get a little bit closer to that pre-pandemic path. You're still a little bit further down. Some of it is coming back with the CapEx side. But again, it's going to be a matter of how much of that CapEx comes up, or you're going to start to see a little bit caution. You're going to start to see that come down. That's where you're going to start to see this competition in terms of when do we get back above that path? Is it Q4? Is it Q1? And I would say it's probably closer into Q1 that we get back above that previous path, as we're already above, back to normal. But it's just getting back to what that path looked like prior to. But it's just, how does inventory look? How are prices looking? And this is where when you could start to see some of the CapEx roll over as they look to wait for prices to normalize and focus more on inventory instead of some of these near-term investments. But when you look at what the U.S. government is doing, since 2008, the low interest rates have outweighed the larger budget deficits, because when you look at the budget deficit, which exploded in 2008, and then continued to go higher pretty much every year through 2021, but you're borrowing more to fill it because your tax receipts are down, and you're seeing almost over 50% of your budget is now being financed from rates, and that's fine as long as rates are low. But as rates start to go back up, that's when you start to see some of the pressure, because your net interest payments as a percent of GDP still fairly low. But when you roll it, and when you start to see some of these pressure points between the 10-year, the 20-year, the 30-year, how is that going to play out, and what does that long-term money really cost you? As you can see that as that deficit continues to expand, now obviously not as bad as 2020, but still at a pace that we really can't afford over the longer term. But when you start looking at some of that CapEx that is going to be spent, you can see that the average age of U.S. fixed assets is very old. We're almost at 24 years old for the average age of U.S. fixed assets, which means that they're going to need investment. They're going to need rejuvenation, which is one of the things that we're looking at with our hydro dams, where they're great assets that have been ignored for 3 to 5 years and could just need a little bit of elbow grease, some investment, and all of a sudden they're going to start churning out a lot of, additional power side, anywhere from 20 to 30% more. And that's just one example. What about, assembly lines? How old is the equipment there? There's going to be this turnover and this reinvigoration, which again is going to be that tailwind to some of the headwinds that we've been describing over the last few months. But the supply chain issues are still there, especially in Asia, Europe, and North America, and continue to get worse across some areas. And we're going to talk about some that are getting a bit better, especially when we start looking at dry bulk. But one of the biggest issues that we've seen are, again, the empty containers. A lot of containers are stuck in the U.S. and can't get to the areas that they need to be, either due to the unable to get on a boat, the wait for the backfill because you try to backhaul. By taking, a company will take the container, unload what the contents are in there, reload it with contents that, whether it's semi-finished or finished goods, and then sending that back abroad. So yeah, that's where you get a lot of this disconnect in terms of the empty outbound containers, and also leads to what we've seen with that big disconnect between the trade deficit at this point. Now, when you start looking at the positive side, the Baltic Exchange Dry Index has had a steep fall. Now, still obviously very much elevated from where it was historically, but as China comes after prices, when you look at coal, iron ore, rebar, a lot of those products come on dry bulk, and that has come down after seeing this big rise, starting to kind of offset some of the price pressures, but again, still very much there. But then when you look at the U.S. consumer, there's some competing sides. So let's look at the positive one first. So there's no slowdown evident in consumers' Google searches for going out. Activity related to car rentals, flights, hotels has been picking up. So we continue to see people willing to do more, some additional activity coming into as we head into the holiday season. But then when we start looking at some specifics about this current holiday coming up, the highest income travelers are most likely to cut back on Thanksgiving travel. All adults said that always or sometimes travel before COVID-19 was at 47%. Will or might travel in 2021 is at 35%. And you can see just based on income levels that you've had the biggest cut in the higher income individuals that are reducing their travel plans. But then when you look at, well, what does that mean? Well, high earners cut back. And when you look at 2021 plans, there's going to be more day trips. There's going to be less longer duration trips, but day trips are increasing. And this is what we've been talking about when we look at the EIA show. You're seeing activity pick up for the shorter distances, just not the longer distances, which is a nice pop for local. But again, you're not going to see the same type of demand as people cut back on some of their extended holidays. But when you look at wealth and how has the wealth changed over time, you can see that the aggregate net worth of Gen X households jumped by 50% since COVID-19. So when you look at really the baby boomers and the Generation X, you've seen a bigger increase in aggregate wealth. And it's just they're older, so they have more money in the stock market, whether through 401ks, through their own trading. where you've seen less in terms of the millennial side and the silent generation, just because they have less disposable income, less, their salaries are, well, I should say on the millennial side, salaries are lower just because they haven't been in the workforce as long and they haven't built up that 401k or their trading portfolio or just, the IRA that they have. And they also don't own homes. So that's where you've seen wealth and been increased on the back of equities, equity holdings and households, which again is some of those things that are missed out by the younger generations. Now, when you start breaking it down, would you say you're financially better or worse off than before the COVID-19 pandemic? So even though your wealth may not have grown as much, when you look at the millennial backdrop of that, 25 to 35 or so, you're seeing people are saying they've done better. So so essentially that key 18 to 54, a lot of them saying they're either better or the same versus previous, which again is some of that positive. It's just, what does that mean in terms of buying a home, being more involved around? And we've actually seen a big drop off in people leaving apartments to go to purchase a home, which we'll talk about in segments 2 and 3. But that's just some of the important pieces that I think are interesting when you look at global back to US. And now in the next segment, we're going to go deeper into what is some of the US data sets saying and what did Q3 GDP come in with and what do we expect going forward over the next quarter.